Hey guys, this is Humphrey and welcome back to the channel. So with 2022 in full swing, we're about 10 or 11 days in now. Many experts believe that it'll be harder to make money in the stock market this year. The US is suffering from high inflation, proposed interest rate hikes, and everlasting supply chain issues, which seemingly just don't go away. So with inflation starting to spiral a little bit out of control, one asset that you can invest into to protect your money against inflation is investing through stocks, but more specifically, dividend stocks. But first, I have to remind you guys that I'm just some random dude on the internet, and while I do love talking about investments and dropping the occasional Taylor Swift reference, it doesn't mean that I'm gonna be right on all of my investments. So make sure you do your own research and make sure that the assets that you buy fit into your portfolio whenever you're taking in information online, whether it be from me, an article, or other YouTubers. All right, so let's first start with the basics of what a dividend is. It's simply a portion of profit that a company passes back to you just for holding their shares. For example, Coca-Cola has been paying a dividend for over 60 years with 60 years straight of dividend increases. As of right now, they pay you $1.68 per share that you own per year. Now, these dividends are typically paid quarterly, but in general, dividends can also be paid monthly or as an annual payment. All right, so here's my Taylor Swift reference for the video. Because we're talking about Coca-Cola, you know who likes Diet Coke? It's Taylor Swift, and also me too. Now think of a dividend as a thank you from the company for holding their stock. Now for the company, dividends will help increase investor loyalty, while for you, the investor, it gives you predictable income, reduced risk, and you can also profit without selling the stock. Dividends are one way that the company will reduce the amount of paper hands in the market and incentivize those holders to actually keep holding those shares. So why should dividend stocks do well in 2022? According to Fidelity sector strategist Denise Chisholm, I hope I said her name right, during periods of high inflation, stocks that increase their dividends the most considerably outperformed the broad market. As we can see with this graph on the screen, historical inflation since 1871 has been roughly 2%, and the annualized growth of dividends is 3.7%. In years with record high inflation, being able to find a high quality dividend paying stock will come at a premium. The bottom line is that when stock prices struggle and volatility increases, consistent dividend payments are gonna help stabilize your portfolio since they'll be paying you consistent income. In addition to fighting inflation, dividend paying stocks have proven to outperform non-dividend payers in the long run as well. Now, a quick side note, my team and I have been releasing research reports on 10 stocks that could outperform the S&P 500 in 2022 over on my Patreon, and of those 10 stocks, 8 of them are dividend paying companies. If you are interested in reading those reports, the link for that will be in my description below, and we've already received a ton of good feedback from the members in our community. Now, there are gonna be some people that say dividend stocks are for older people who just want income, and I tend to agree that a full portfolio focused on only dividends is best for someone with lower risk tolerance. However, I do think that having a healthy mix of dividend stocks in an environment that we are currently in right now is gonna help you sleep a little bit better at night, especially if it's involved in a drip plan. Even in my own portfolio, 25 of my holdings at least pay some sort of dividend out of 34 holdings. Okay, so when you do receive dividends, most brokers will offer you 2 choices. The first is to reinvest that dividend into the underlying stock, and that's known as a DRIP plan. That stands for Dividend Reinvesting Plan. The second option is just to simply keep the cash. Now, personally, I always reinvest dividends and let compound interest work its magic over time. Fidelity actually found that approximately 40% of overall stock market returns since 1930 can be attributed to dividends. Now, if you don't want to pick individual dividend paying stocks, that's perfectly okay as well. Picking individual stocks is a little bit scary, and studies show that people who pick individual stocks rarely outperform the broader market. If you're currently investing in ETFs and mutual funds, such as VOO, which tracks the S&P 500, or VTSAX, which tracks the entire stock market, you're already dividend investing. I'll link you guys to the websites of other ETFs that focus solely on dividend paying stocks below in the description, such as SCHD, VYM, and VIG. Before we look at examples of dividend paying companies, there's a few key terms to know that will always pop up when researching dividend companies. The first is dividend yield. A dividend yield is the dividend payment divided by the current share price. So for example, if a hypothetical stock, let's say Apple, is currently worth $100 a share and their dividend yield is 1%, That means their dividend payment will be $1 per year. A mistake that I often see investors make in investing in a dividend stock is simply just investing in one because it offers a super high dividend yield. That's a pretty dangerous way to invest and will probably not work out in the long term, and that's because high dividend yields are attractive at first glance, but it's actually quite harmful for the company's growth and future to offer such a high dividend. Every dollar that a company is paying out in dividends is a dollar that the company is not reinvesting in itself and generating more capital gains. Ultimately, a high dividend yield signals that management prefers to pay out a dividend rather than reinvest in the company, given the lack of potential upside. To them, it seems more optimal to pay out shareholders than grow the business, which speaks volumes about the future of that company. Another term you'll often run into is the payout ratio, and that's simply the percentage of earnings a company actually pays out as dividends. For example, if a company earns $100 million this year and has a payout ratio of 50%, that means they pay out roughly $50 million to their shareholders in the form of dividends. It's important to note that a low payout ratio isn't necessarily bad. A low payout ratio simply means that the company is still reinvesting most of their earnings and expanding their own operations. Since they are reinvesting in their business, the overall company will likely benefit, resulting in a more efficient business. So if you see a low payout ratio, that's not necessarily a bad thing. Ultimately, earnings growth will likely mean dividend growth later on, so I see low payout ratios as an opportunity to invest in a company that still has a lot of room to expand their dividend. On the flip side though, a really high payout ratio of over 100% means that the company is paying out more in dividends than it's earning. That means the dividend is likely unsustainable and will likely decrease or just cease to exist in the future. Lastly, an important term to understand is a company's ex-dividend date. An ex-dividend date is just the date that you need to own the stock by to actually receive that dividend. Typically, you gotta own the stock at least a day before the ex-dividend date in order to be eligible. So for example, if the ex-dividend date for a stock is on January 11th, make sure you own the stock by market close on the 10th, which is the day before. Some people try to game the system and think to themselves, man, if I buy the stock the day before the ex-dividend date, then I can just wait to collect the dividend, then sell the stock on the next day. Easy money, right? Unfortunately, this does not usually work because typically on the ex-dividend date, the stock price will decline by the amount of the dividend itself. Part of the reason why this happens is since a dividend payout comes from the company's cash reserve, it technically decreases the value of the company, which the market reflects. All right, so now that we have a general idea of dividends and some of the definitions, let's actually go into my computer and we'll take a look at two examples of dividend stocks. Now, a free resource that I like to use to evaluate a company's dividend is actually seekingalpha.com. Now, before we look at the specifics of a company, a simple way to find out whether a company pays a dividend or not is just to look up the stock on Google and it'll show you on the chart. So as we see here, if we go to Apple stock, you can actually look right here and it has a dividend yield of 0.51%, which means that it does pay a dividend. If the company doesn't pay a dividend yield will not actually appear. So actually, if we just type in Tesla stock right here, you can see that it's just blank for Tesla. A dividend yield is blank. You'll almost find that all hypergrowth stocks will not pay a dividend, and this is because they're aggressively investing in themselves rather than giving away their money to shareholders. A dividend paying company is usually a more stable company that has already set up their foundation and typically is a bit more mature and has been in the market for longer. All right, so let's actually go back to Seeking Alpha and type in Apple right here, and let's actually look at their dividend stats. Okay, so once you're at this screen, you're just gonna hit this button right here, which is called dividends. And this is their dividend kind of scorecard or dividend summary page. And the really cool thing about Seeking Alpha is their grading feature, which basically shows you the company's dividend relative to the sector. The first thing that I like to look for are the general numbers that we discussed. So things like the dividend yield, which is right here at 0.5%, the 5-year growth rate of 9.18%, and the payout ratio, which is 15.44%. This signals to me that Apple is still spending a lot of money on R&D and expanding their own business. Now we know that this is true with the rumors of the Apple Car, a new VR headset, and new iPhones and iMacs being released every single year. Now, starting with dividend yield, we can actually see that they get a D rating right here. Now, remember that the yield isn't everything though, but it's not really great relative to their peers. But moving on to dividend growth, you can actually see that it gets an A+ in that sector of Seeking Alpha. And if we actually click into dividend growth, we can actually get way more statistics about its dividend growth itself. Now, I'm gonna zoom in a little bit right here just so we can read it a little bit earlier, but we can see that some of these stats are really good. For example, dividend per share growth right here is on 5-year average about 9%. In addition, we can look at all these other metrics and see that Apple is doing quite well. Obviously, it's the largest company in the world, yet it's still growing on a 5-year average basis on revenue, at least in terms of revenue, at 6.89%. Free cash flow is increasing and also earnings are increasing. This is a good sign, as that means Apple probably has more money to pay out larger dividends in the future. Now let's actually go back and let's click on dividend safety. It gets a B+ relative to its sector, but let's click on it and see what's going on here. You can look at all the stats on their dividend safety right here, but I actually like to just scroll down all the way down to the payout ratio section, and you can actually see that the payout ratio has been decreasing substantially since 2020 right here. Apple hasn't been increasing their dividend at the same rate as their earnings growth rate. Now, ultimately, Apple isn't the best dividend stock out there. It's still considered to be a growth company, but offers an okay dividend. So as Apple's business fully matures, you can expect its dividend yield and payout to increase. Now, this is the same process that you can use with any other stock on Seeking Alpha. And again, this resource is free. Okay, so now I want to give you another example of why just looking at a dividend yield can be dangerous. So a stock that demonstrates this risk is actually Invesco Mortgage Capital, which is ticker symbol IVR, which is a REIT. Now, at first glance, we can see that the dividend yield is 12.29%, which is pretty crazy high, and the PE ratio is 9.06, which actually signals that it is a reasonable valuation. But if we go back to Seeking Alpha and we actually type in IVR, we can actually see that this will tell a different story. Right off the bat, if we actually just scroll down, we can see that the 5-year growth rate is minus 26.21%. So let's actually look a little bit further into their dividend growth. And if we scroll down on the dividend growth page, we can actually see that their dividend growth has been declining year over year, as well as it's been declining every single year since 2010 all the way to 2021, with the annual payout growth really accelerating in the negatives as of the last 2 or 3 years. Now, moving over to dividend safety, their trailing 12-month dividend payout ratio right here is over 100%. That means the money that they're bringing in cannot sustain the dividend payouts. Now, this leads me to believe that they'll continue to decrease their dividend payments over time. So that would be a stock I'm personally avoiding. And also, this is why you just can't chase a dividend yield, because if the underlying business is not a good one, then you could lose more money in the underlying asset than you would make up for with that dividend. If anything, I hope that shows you that you can't rely on one single metric when evaluating a company. You need to see the full picture. If you'd like more info on dividends, I actually have these videos that I created on how to start a dividend stock portfolio with $1,000 and some of the better dividend ETFs out there, and I'll leave those right up here. So I hope that you enjoyed today's video. Make sure to subscribe, and I'll catch you guys in the next video. Peace.